everybody. I'm Linda Lovey, Lovey Wealth Management. I'm a financial advisor, and I'm going to discuss risk because a financial advisor will help you avoid the pitfalls that people can sometimes fall into. So the different risks that I'm going to talk about is inflation, longevity, liquidity, and market risk. There's a bunch of other ones, but this is the four that I'm going to talk about today. So I'm going to use that with the story of an imaginary couple, Joe and Lisa. So Joe and Lisa are a young couple. Joe's got his first job, and he's having his paycheck going to a checking account. So the checking account offers liquidity. Why does a person need liquidity?
Pay their bills.
Exactly, pay their bills and handle whatever kind of emergencies come up. I always tell people if you have enough money in a liquid situation, then you can turn emergencies into inconveniences. For example, let's say your transmission goes out. You have enough money set aside, then you can use the money in your accounts to pay for it instead of having to put it on a credit card and not have to build up credit card debt. So now, Lisa, she's plugging along, and she's got a checking account, but she decides that she's going to also open up a savings account because the savings account can offer you a little bit better rate of return. This is helping to work against inflation. So they're plugging along. Joe decides now, after he's been building up some money, he's going to buy some CDs because typically CDs will even offer more return than a checking account or a savings account. The only thing with CDs is, though, you have a term, and if you take the money out before that term, sometimes you pay a fee or you lose interest. So Lisa, she decides that she's going to use CDs as part of her savings, but she's going to stagger them. So she's going to maybe buy a 6-month one, a year one, and a 3-year one. That way, each time frame, there's different monies coming available that she has access to. All right, and she's getting a better return. All right, so now, what is the risk with these investments that I've talked about so far?
Inflation.
Yep, inflation. We're not meeting the cost of inflation. So these types of investments should be used for your shorter term money and moving forward with that. And then you can use other kind of investments, get a better rate of return to beat inflation. All right, now these guys, Joe and Lisa, end up getting married and they buy a house. So they're plugging along. And if you buy a house, what does that now mean that you need for your cash reserves? You need to have more money set aside because you have this obligation for this mortgage. You want to make sure that you can handle any kind of expenses that comes up with that so you're not putting your house at risk. Right now, next thing you should do at this point, get a will or a trust. I like to see people use trust in a lot of cases. That way you're having your assets that cannot be titled to a beneficiary being handled the way you want. Going along, time is passing. Now Joe decides he's going to buy stocks. He wants to get a better rate of return. So he goes out there and buys his individual stocks. The issue with that is a lot higher risk to them. You can get a lot higher rate of return, but you do get a lot more risk, especially depending on what kind of a stock you buy. A financial advisor will help you pick and choose as you go forward with that. Lisa wants to get a higher rate of return also. She decides, though, she's going to use stuff like mutual funds or exchange traded funds to get the opportunity for the higher rate of return, but she gets to lower her risk. The reason why that's lowered is because when you buy those kind of funds, you're buying a whole bunch of stocks instead of one. So like Joe, if he had one stock and that company went belly up, he'd lose all his money. But Lisa, buying the mutual funds, there's typically 75 to 150 different stocks held within that fund. So if one company goes belly up, it's not going to affect her portfolio quite so much. Now, is that liquid?
No.
Actually, they are. The only thing you have to worry about is if it's held in an IRA or any kind of a qualified plan. That gives you a whole different set of rules. Again, a financial advisor can help you with that. All right, so now, next thing, more time is passing by. Joe's built up enough money in his accounts. He wants to start using a managed money platform. What that is it's a team of people that are actually buying and holding different funds and stocks for you within that portfolio. They can offer you typically a better rate of return and help ward off some of your risks. They can build a portfolio according to your risk tolerance. You usually need about $25,000 enough for that. Okay, now time goes by, they're about 10 years from retiring. Lisa decides that she wants to have a little more safety because she's worried about everything being in the market. So she gets into an annuity, and there's different kinds of annuities. There's fixed and variable and so on like that. So if she goes into a fixed annuity, for example, she can get a set rate of return, and then she can also create a lifetime income. Again, all these different annuities have different bells and whistles. And then there's one that I currently like to use a lot, that if you don't, or if you have an issue with long-term care, your income that you created off of it can actually go up to twice the amount for up to 5 years to help cover those kind of costs. Little disclaimer when it comes to annuities, compliance here says, I need to say, disclaimer, fixed annuities are long-term insurance contracts and there is a surrender charge imposed generally during the first 5 to 7 years that you own the annuity contract. Withdrawals prior to age 59 and a half may result in a 10% IRS penalty. In addition to any ordinary income tax along with that. Any guarantees of the annuity are backed by the financial strength of the underlying insurance company. Okay, so that helps take care of your longevity. By having an annuity, some of these can pay up to the age of 114. When you hear of people winning a lottery and they're getting a lifetime payout, or if you work for a company and they offer you a pension, that's an annuity. So they're really misunderstood. Okay, now, Joe, plug along, decides he's going to get life insurance. And there's basically, to simplify it, 3 different kinds of life insurance. Joe decides because he's more aggressive, he's going to buy the variable kind. What that is you buy insurance, a certain dollar amount of your premium payment, a portion of it goes toward paying the cost of insurance. The other portion goes into the investments called sub-accounts, which is basically like mutual funds. And that money grows in value, goes up with the market, and it can also go down with the market. But over time, because it's a long-term investment, you usually want to figure 10 years, you can grow some money. Then later on, you can use it to actually fund your retirement, create an income, and it's tax-free, and you can also leave a legacy. So in case something happens to Joe, something's left behind for Lisa. Lisa decides she wants to get life insurance, but again, she's more conservative. She's going to go with more like a type like a universal, which that is the same idea. Money goes into the account, part of it goes for the cost of insurance, and then the other portion goes into a fixed account, so you get a fixed rate of return. Again, same thing. She can create an income source in retirement, and then she leaves a legacy for her husband if something should happen to her. So these are just a few of the items that a person can get themselves into when they say, you want to be diversified. That doesn't mean, just having mutual funds here and mutual funds there and just whatever. It's all these different solutions to take care of the different things that come up in life. I'd love to be able to help you with a lot of these different ideas and give you some direction. I will also keep you away from all the bright, shiny objects that's out there. Always, what about this investment? What about that investment? So I can help you with that. Meanwhile, I'm also doing an event. It's going to be July 9th, total wine tasting, networking, and then I'll talk a little more in depth about the risk management. So, and then I've also got a little sheet with little comments about, tips and summary of our conversation here. So, if you can make it to the event, please RSVP. And thank you, and happy 4th of July.
Can I ask a question?
Sure.
Okay, just about your disclaimer. So if you had an annuity, and like the insurance company that was backing it or whatever goes bankrupt, do you lose all your money?
No, the other insurance companies within that state come up and take over the contracts. There's an
So
insurance.
there's not like a way to lose your money on that?
Not typically. You want to watch what the rating is of the insurance companies. There's different ratings out there, so you can watch it. You look at the strength of it. The other thing to look at is how much are they leveraged. So it's another thing as far as safety is, I'll help you look at companies that are good and solid, that have a good track record to help you avoid the pitfalls. Yeah.
Just a quick question on life insurance. A lot of people will buy life insurance in their lifetime. Can you explain the difference between term, universal, whole life, and variable life?
Sure.
The
So
pros and cons of each.
you bet. So term is less expensive. It is strictly pure insurance. So 100% of your premium goes strictly for the insurance. Only it's like less than 2% actually pay out, but it's a great way to cover a mortgage, and you leverage your money instantly, and cover, specifics. So a lot of times it's good to even have maybe a term to cover a mortgage, and then maybe something that builds up cash value for a longer term. After you have to set a time, let's say by a 10-year term, after 10 years, that premium that was set will start going up higher and higher to the point that eventually you can't keep it up. So it's built more for a specific time, a shorter time, instead of building up. Then as far as your variable, those are the ones that are invested in the market. So it's going to go up and down based on what the market's doing. You get to pick your risk tolerance, so it can be either conservative or aggressive. So you can grow it faster or slower, depending on how much you can tolerate the ups and downs of the market. And it's the more expensive. And then the universal life is kind of in between cost. That's the one that when you put the premium in, a portion goes for the cost of insurance, and the other goes into a fixed account. So it's going to go steadily along, again, to use as a tax-free source of income later. Any other questions?
Any other questions?
All right, thank you, everybody.
Linda, tell us how people get a hold of you.
All right, so my number is 775-544-4714. I also have a website, www.llovie.com, where I have stories on there of different real-life situations, so you can learn some of the pitfalls other people have made, all confidential, by the way. And then I can also be reached email, llovie@brokers, brokersifs.com.